Cargo terminals in the Gulf of Mexico started rejecting ships before sunrise, not because of a storm, but because Beijing sent a 9-line update to its customs portal that rewired every trade algorithm on Wall Street. Soybeans that were priced for Brazil suddenly had no buyers. U.S. rare earth firms were warned their license windows might not reopen. And inside Washington, Scott Bessent was handed a briefing folder so urgent it arrived without a cover page. For the first time in years, China wasn't signaling frustration, it was signaling capability, and the numbers moving through global markets said the United States had hours, not days, to react. Bessent laid out the United States plan in interviews. He claimed President Donald Trump gave him enormous leverage with the 100% tariff threat starting November 1st, and that, he said, we are on the verge of a very substantial agreement. He indicated China will make substantial purchases of United States soybeans and delay its rare earth licensing regime by a year. At the same time, Trump is poised to hold off the tariff mega hike. That is the scenario we must dissect. Who really holds the winning hand? Both sides walked in with cards to play. On the United States side, we will raise tariffs to 100% if you don't move, announced publicly. On the Chinese side, we will move to Brazil and Argentina for soybeans, and we will tighten rare earth licensing. Now Bessent says the Chinese side signaled delay on the rare earth rules and resumed United States soy purchases. That is the American readout. We have no assured view of what concessions Washington made behind the scenes to get that, so the winning hand might not be so clear. Let's dig into the numbers. China in September imported 0 United States soybeans for the first time in 7 years, after United States farmers expected Beijing's demand to return. China's shift toward Brazil and Argentina, with Brazil's shipments jumping roughly 30% and Argentina 92% in the month, confirms that United States producers were sidelined. So if China now agrees to buy substantially, as Bessent claims, that signals a U-turn, but the baseline was 0, and the path back remains steep. Turning to rare earths, China tightened its export control regime in early October, adding more elements and licensing rules for defense and semiconductor sectors, while United States firms still lack alternative refining scale. China processes more than 90% of the world's rare earth elements and magnets. The United States currently has only 1 operational mine. That gives Beijing leverage, even as it offers a pause on further escalation. A 1-year delay buys time, not independence. When we add in the tariff threat, the logic becomes sharper. Trump's threatened 100% tariff would have forced global supply lines to reroute overnight and margins to compress. The baseline scenario of 0 soy imports plus tightened rare earth controls created a squeeze on American farmers and manufacturers. If the United States pauses the hike, that alleviates pressure, but only if China follows through. The central risk: Washington may have traded away quiet concessions for headline gains. Meanwhile, consumer sentiment in the United States is fraying. The University of Michigan survey shows year-ahead inflation expectations are elevated near 4.6% and longer-term expectations near 3.7 to 3.9%. That suggests households expect higher prices, and such inflation tends to hit consumption-based economies hard. So if tariffs are paused but prices remain high, the United States economy still endures damage. On the manufacturing side, a recent S&P Global Market Intelligence analysis estimates that companies worldwide are on track to incur at least $1.2 trillion more in expenses this year because of tariffs and supply chain disruptions. That burden is largely absorbed by firms now, but will eventually pass to consumers. So the negotiation isn't just about soybeans or rare earths. It's about whether the global substitution and cost wave gets reversed. Let's pause the aide's whispered calculation of vessel lineups in the Pacific, a trader scanning ship logs in Santos loading Brazilian soy for China. The frame comes into focus. Soybeans are a fast-moving commodity. If Chinese purchases resume, United States farmers will breathe. But if China bought 0 in September, tangible change must show in shipping manifests. Rare earth supply chains, by contrast, are slow. Refining new capacity takes years and inventory moves slowly. So a 1-year pause doesn't suddenly erase China's leverage. What might Beijing be getting in return? If China resumes soy purchases, Washington may have quietly softened export controls on intermediate goods or delayed other industrial penalties. If Bessent is correct, China agreed to delay its new rare earth licensing regime, signaling a thaw, not a full reversal. That suggests the United States may have given Beijing breathing room. But we don't yet know exactly what the United States conceded. The logic of bargaining, you get a concession only by giving one. So the question remains, are United States agricultural hopes balanced by United States industrial risks? Meanwhile, the rare earth leverage remains profound. Even as China increases mining outside its borders, refining and value capture remain highly concentrated. Firms in the United States and allies are racing to build alternative supply chains, but the scale is years away. A pause delays the threat of escalation but does not guarantee independence. So if the framework holds, United States manufacturers buy time, but the structural dependence stays. Back in Washington, Bessent emphasized sound monetary frameworks and calm for allies in Asia as part of the deal narrative, indicating the United States is managing both diplomacy and market optics. A pause in tariffs, if credible, would change importer behavior. Fewer panic orders, fewer margin erosion hedges, and perhaps less consumer risk. It's a containment play, not a conquest one. We can frame two falsifiable futures. First, if United States soybean bookings remain negligible by mid-November, the claim of substantial purchases will lose credibility, and United States farm payments and political costs will spike. Second, if China quietly adds new items to its export control list or begins licensing renewals more slowly, the one-year delay becomes a mirage and supply chain stress returns. On the flip side, if the leaders' meeting between Trump and Xi Jinping, scheduled in Korea, yields a signed side letter anchoring the pause with quantifiable milestones, the markets will begin repricing risk downward. The scene ends not with a handshake, but with a bill of lading on a ship's hull that reads duty 100% or reads duty 0. In Santos, Brazil, the loader pours soy into a hold bound for the Pearl River Delta, and in Ohio, a warehouse manager checks a reorder sheet priced under the shadow of impending tariffs. The difference between deal and no deal plays out across ocean freights and inventory spreadsheets. If Bessent lands his pause, the first proof will show up in shipping manifests and license approval logs. If he misses, the tariff line on that bill of lading stamped at midnight will tell the story. Behind the closed doors of Kuala Lumpur's Summit Hotel, negotiators from both sides weren't just trading notes on soybeans or minerals. They were mapping the next stage of global trade order. Officials familiar with the discussions say China's economic team floated an alternative tariff management mechanism that would tie United States duty adjustments to commodity price bands, effectively creating a shock absorber model that could expand to other economies if successful. If adopted, it would mark the first formal link between inflation control and bilateral tariffs in modern trade policy, a potential blueprint for other export powers watching nervously from Europe and Latin America. Beijing's calculus is rooted in stability. The Chinese economy's manufacturing index ticked up slightly this month for the first time in half a year, driven by export orders to Southeast Asia and Africa. While domestic property weakness persists, China's factory output and car exports, especially EVs, remain robust. A United States tariff hike could derail that recovery just as it starts to gain traction. Economists at the China Academy of Social Sciences say that every 10-point rise in United States import tariffs could shave 0.3 percentage points off China's GDP, but that the global inflation shock would hurt the United States even more severely. In other words, both sides are gambling on pain thresholds, not principles. Inside Washington, the real constraint isn't diplomatic but political. Corporate donors and farm state coalitions are lobbying aggressively to postpone the tariff escalation. Freight forwarders have warned the administration that ports from Long Beach to Savannah are still clogged with backlogs from earlier customs checks. If tariffs double, clearance delays could stretch into weeks, raising costs on essentials from electronics to medicine. Treasury insiders whisper that this supply chain fatigue is what pushed Bessent to move quickly before the November 1st deadline. A calculation made, as one aide reportedly said, with one eye on the grocery aisle and the other on the bond market. Markets are already responding to the faint scent of a deal. Semiconductor and electric vehicle stocks in Shanghai and Shenzhen jumped on speculation that Beijing's pause on rare earth restrictions will hold through next year, while United States agricultural futures climbed on the first credible talk of Chinese soy purchases since the freeze began. Commodity desks in Singapore report that forward contracts for United States Gulf soybeans to China have quietly resurfaced, still limited in volume, but, symbolically significant. Traders scanning ship logs in the Pacific are beginning to see small diversions. 2 Panamax vessels originally slated for Brazil now being rerouted toward the Gulf Coast. It's not yet a flood, but it's movement. Behind the commodity headlines lies the deeper strategic chess. China's Ministry of Commerce has been quietly fast-tracking export permits for precision magnets and critical materials to friendly economies such as South Korea, Malaysia, and the UAE, an effort to show the world that reliable partners will get priority access. It's a subtle message. Cooperation earns supply. Confrontation earns delay. For Washington, that creates pressure to prove that diplomacy can unlock access faster than coercion. If Bessent fails, the symbolism will be powerful. China keeps control of the materials the world's high-tech future depends on, while the United States faces rising costs at home. Financial analysts are also watching the yuan. Since Trump's tariff announcement, the Chinese currency has strengthened modestly, signaling confidence that Beijing sees a path to stability. A stronger yuan blunts inflation on imported commodities and offers a subtle retort to Washington's inflation narrative. Meanwhile, Treasury yields have wobbled as traders factor in the risk that new tariffs would push the Federal Reserve to defend price stability with higher interest rates, something the White House wants to avoid before an election year. The link between tariffs and bond markets has rarely been this direct. What makes this round of negotiations more volatile than 2019 is the information war surrounding it. Chinese state media are portraying the talks as proof of Beijing's strategic patience, while United States outlets frame Bessent's diplomacy as tough but fair. Neither narrative can mask the stakes. Both economies are effectively co-managing global inflation. If tariffs rise and rare earth flows slow, it won't just be an American or Chinese problem. It will be a planetary one. From Germany's auto factories to India's smartphone plants, cost curves will tilt upward within weeks, and so the world waits. Cargo trackers watch the South China Sea for the first soybean shipment clearing under a United States flag. Semiconductor firms monitor export licenses for any delay from Beijing. Central bankers parse every sentence from Bessent for hints of policy cooling. For now, the board is set. The players hold their pieces, and honestly, one wrong move could unleash another $1 trillion in global costs. The question isn't whether either side can win, it's whether the world can afford another round of this economic chess game. By the time night settles over the Pacific routes, a quiet pattern begins to emerge. A single soybean vessel holds just outside the Pearl River Delta, transmitting no offloading schedule. 2,000 miles away, a rare earth shipment bound for the Midwest vanishes from its expected checkpoint and reappears on a slower, more cautious path. And inside a secure room at Treasury, analysts mark a new anomaly. Chinese purchase orders creeping upward at the exact moment U.S. tariff clocks edge toward deadline. None of it proves a deal. None of it disproves one. But taken together, it shows two superpowers adjusting in real time, each waiting for the other to blink. The next signal won't be spoken. It will appear in the ocean traffic, the warehouse logs, and the price bands that move without warning. When it does, the entire world will know which side decided the night's direction, and which side will spend the morning absorbing the cost. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.